Hello, I'm here with Michael Greenberger, a professor of law at the University of Maryland. Michael, great to have you with me today.
Nice to be with you.
You have had a long experience, not just as a law professor, but you've also been with the director of the CFTC. You've worked for the Department of Justice. You've done a lot in the area of financial regulatory reform, or maybe we could say the lack of it in some areas. But interested to hear your perspective of where we stand post the Dodd-Frank bill.
Well, I'm not very optimistic right now. I think we had a moment in the sun when Dodd-Frank got signed. As a headline, my view was Dodd-Frank was not an A or an A minus, at best a B plus, probably be a B, but it was an advance in the regulatory era that we had not theretofore been able to achieve. I think for some reason, maybe they were stunned by the meltdown itself, but the banks really did not put up the best fight they could put up in fighting the statute. But they have put up a fantastic fight in stopping the correct implementation of the statute, going into court, spending lots of money, challenging provisions as implemented by the SEC and the CFTC, Commodity Futures Trading Commission, which has a very much increased role under Dodd-Frank. And they've invaded the regulatory process to the point where they're 24 hours a day, 7 days a week, working on convincing commissioners at the SEC, commissioners at the CFTC to pull back and not fully follow what Congress intended in Dodd-Frank. At present, as we sit here right now, two of the foremost protectors of Main Street, Gary Gensler, who had been chair of the CFTC up until
December of last year, and another commissioner, Bart Chilton,
who was actually appointed by President Bush originally. They were two real fighters for the well-being of the economy. A lot of us were very surprised that Gensler either didn't get renominated or was not given a more important position somewhere. He had been Under Secretary of the Treasury in the Clinton administration. Gary maintains that he was just worn out from 5 years of hard work. Many of us are suspicious that he was not really welcome back. And the replacement commissioners are much more friendly to Wall Street. And as a result, at the CFTC, which now has jurisdiction over $300 trillion in notional value financial instruments, the very kind of instruments that are uniformly thought to have caused the meltdown, you have 5 commissioners who are Wall Street friendly, 2 of them Republicans, not unexpectedly, but 3 of them Democrats. And it's my view that this is the most Wall Street friendly commission in the history of the CFTC. You would think President Obama, who is thought to be progressive, wouldn't have loaded the commission with these Wall Street friendly types, but there it is, it's been done.
Well, you would have thought that, but at the same time, there is nothing in his historic record which suggests that he wouldn't be friendly to Wall Street. I mean, his first Treasury Secretary was certainly not, by any stretch, a hostile opponent to Wall Street, bringing in many of the same people who were in the Clinton administration.
Yes, you're right. And in fact, Gensler was in the Clinton administration.
Yes, although he had an interesting Damascene conversion, it seems.
He did. And ironically, I mean, I will never forget the day in November of 2008 when Obama announced his financial regulatory team. First of all, he had Bob Rubin standing next to him, and he brought in Geithner, Summers, Mary Shapiro, who was not the most aggressive SEC chair, and Gary Gensler. And most of us at the time thought, yeah, this is a perfect pro-Wall Street group. And Gensler broke out of that. By the way, he said he was going to break out of it after he was nominated.
I remember he said that, and in fact, he also said he consulted for a long time with Brooksley Bourne, who you worked with and you know well, and obviously was one of the early opponents of this deregulatory trend toward individual.
Exactly. Yeah. And unlike any other nominee I'd ever seen before, probably since, Gary identified what his opposition was. He went to his opposition, going to visit with Brooksley and talking with her on a regular basis was sort of going to the jugular of what was going to be in his way of being nominated. And he convinced both by words and deed that he was going to be a Main Street regulator-friendly chairman. And in fact, he was, from the perspective of progressives who want to see Wall Street reined in, Gensler was the best regulator that Obama nominated. I fear if they had known that was the way he was going to be, he would have never been nominated. But nevertheless, he was there. To the extent Dodd-Frank is tough in the regulation of derivatives, we can thank Gary Gensler for that. In terms of the effective enforcement of Dodd-Frank, we can thank Gensler for that too. But the minute Gensler walked out the door on December 31st, 2013, things started coming undone. And I think the existing commission is going to blow such big holes into the derivative structure that we're going to be back where we were in 2008.
Which is a bit disappointing because I remember when he announced he was stepping down, there were some people who said he's going to hold on long enough to make sure that he gets some entrenched reforms, but it sounds as if that wasn't the case.
No, I mean, the day after he left, or the first working day after he left, some of the things he insisted upon, for example, there is a big debate going on right now of whether when a U.S. bank holding company conducts its derivative trades outside the sovereign United States, are they regulated by Dodd-Frank or are they regulated by the country that they're trading in? Gensler actually had enough foresight that he had a provision written into Dodd-Frank that made it clear that because a U.S. bank holding company is trading in London or Berlin, they still have to follow Dodd-Frank. Why is that? Because we know, for example, from the London whale experience, where a London trader for JPMorgan lost $6 billion in one fell swoop, or we know from the AIG subsidiary, which was in London.
Operated out of London, yes.
Yeah. So the point is, Gary was criticized for not playing well with others. You know, our allies. He's not listening to our allies. But it was more fundamental than that. If JPMorgan makes bad trades in unregulated markets, those markets, the British, the Germans, the European Union, are not going to be asked to bail out JPMorgan. Who will be asked to bail them out? The United States taxpayer. So what Gensler kept saying time and time again is that our need to prevent dangerous and reckless trading doesn't stop at our shores. When we have a responsibility for JPMorgan or Goldman or anybody else who fails, if they're going to get, as they did in the last meltdown, $12.3 trillion in government subsidies, we better make sure that just because they're trading in London or Berlin or Saudi Arabia, that they follow our rules.
And it doesn't seem as if there is an inclination towards using each jurisdiction to elevate the regulation in each jurisdiction. There does seem to be, on the contrary, a continuation of regulatory arbitrage. And
it's on that very point that when Gensler walked out the door of the CFTC, he was undercut. Because the way the regulatory structure had been set up prior to his leaving, if the other countries didn't have regulation which was comparable to the United States regulation would apply. Again, we're talking about U.S. bank holding companies. And that there was a date certain at which the other countries had to act, the spring of 2014. The minute Gensler walked out the door, they lifted that deadline and put nothing in its place. So now there's no incentive for these other countries to regulate in the same fashion that we've regulated here. Because under the existing rules, if the London whale were to happen tomorrow, the London whale's trading would be governed by the United Kingdom, not the United States. And if the London whale had been with a smaller bank, he would have brought that bank down. And who would have had to save that bank? The U.S. taxpayer.
And there is no sign that the UK regulatory authorities have moved in any respect towards stiffer regulation. My sense was with the Vickers Commission, they had done some things.
They've done some things, mostly dealing with increase in capital, but that's a tricky way to regulate.
Yeah, my complaint about that has always been, that if you raise capital buffers, it's a good insurance policy, but you're insuring against an act that could happen anyway. And my feeling has always been regulate the asset side of the balance sheet, and by that I mean ensure that the activities that give rise to the need for the higher capital buffers are banned or heavily regulated in the first place.
Yes, and Professor Adnati at Stanford has made the argument that their capital is borrowed money.
Yes.
So what is supposed to be there for a rainy day, the bank could default on that too, and then there's no capital. So there's a lot of work that needs to be done here. Quite frankly, as I see it, the Republican Party on this issue is hopeless. The Democratic Party is split, where the top of the party is so worried about campaign contributions, aggravated by the Citizens United case and the case that just came out recently, the McCutcheon case,
which effectively bans any real limitation on campaign
yes,
finance
it essentially
contributions.
says corporations are persons, and stopping them from making campaign contributions is interfering with their speech. If we ever reinstate the draft, I look forward to drafting these banks to go to the front.
It's an interesting reversal. I mean, we had, I think I read somewhere once that we've gone from a position from the Dred Scott case in the mid-19th century where effectively people were treated as property and now to the point where corporations have now been reverted to people. It's,
right, and exactly the corporate form was to take liability away or to limit liability. And that was to say you're not a regular person who can be sued if you've done something wrong for everything you're worth. So that has put a premium on raising campaign funds. And unfortunately, as I see it, the leadership of the Democratic Party, whether they admit it or not, do not want to lose Wall Street funding for their campaigns. The reverse of that is to look at someone like Elizabeth Warren, who started as an inexperienced politician without any natural base and with Wall Street as her avowed enemy, and she was able to raise a substantial amount of money to run an effective campaign. She's now being asked by progressive Democratic senators who are running for re-election to come to their state to raise money for their campaign. I think Elizabeth Warren is a living example that you can be successful as a politician if you do the right thing, and the right thing is constraining the too big to fail banks.
Yep, I would agree with you about that. She is one of the hopeful bright lights of the campaign. So other than Elizabeth Warren, are there any regulators out there that you could point to and say, I mean, we had Sheila Bair, the CFTC.
Yeah, she's gone.
She's gone now.
And as I said, the CFTC, thanks to President Obama, will be the most Wall Street friendly CFTC in the history of the CFTC.
What about Mary Jo White of the SEC?
Mary Jo White, I worked with Mary Jo White when she was the U.S. Attorney in the Southern District of New York. I was in the Maine Justice Department, and we collaborated very successfully. I was very supportive of her nomination. I think it's too early to tell. The rumor was that she was given the job of handling Gary Gensler when she came in and keeping him from causing all these international crises. I have some reason to believe that when she got into that, she realized that Gary was right and the foreign governments were wrong, but I still think we have to wait. And the other thing that's got to be remembered is the SEC and the CFTC, you have to have a majority of 5 commissioners. Now, Gensler, when he was at the CFTC, maneuvered very carefully to keep a majority. I'm not sure that Mary Jo has a reliable majority at the SEC. But everything comes from the President of the United States.
Yep.
Franklin Delano Roosevelt said, "I wear the disdain of Wall Street as a badge of honor." I think the real question we have to ask for the future is, where is Hillary Clinton going to rest in this? Her husband followed Rubin, Summers, Greenspan. He has several times in his post-presidential life, especially post-financial crisis period, has disavowed that philosophy and said he made a mistake. But he's sometimes taken his disavowal back.
Yeah.
To me, the question going forward is, if Hillary is likely to be the next president of the United States, where will she lie on this terrain? Will Rubin and Summers continue to dominate the Democratic Party, even though the base is not supportive of that? Or has she learned from this? And will she be supportive of Gary Gensler's approach? By the way, Gary was an advisor to Hillary in the 2008 election as well. And one can hope that both the historical lesson of the damage the banks did, and even worse than the damage they did, they come out of this crisis stronger than ever. Mm-hmm. Even the bankrupt, the Richard Fulls of Lehman, has houses all over the world. The rest of us, the average American citizen, is struggling, and the middle class is depleting, and savings are being used up, and jobs are hard to get. One would hope that seeing that terrain, the banks who caused the crisis are healthier than ever, more centralized than ever, but the mainstream America is very badly hurt. One would hope that Hillary Clinton sees that and would move in the direction of the base of the party, which is to rein in these too big to fail banks.
One would hope. Well, I guess we'll have to wait till 2016 or before to see what happens.
Yes.
But it's been great chatting to you about this. I hope that your prognostication for the direction which she goes, that she does go in a more Elizabeth Warren type direction, is the right one, but we'll see. But Michael, thanks very much for speaking with us today. It's been really interesting.
You're welcome, Marshall.